Hello learners. So we have been talking about various reasons of market failure, particularly in case of environmental goods. We have identified the various reasons for market failure like externalities. We have talked about public goods, which leads to inefficient production or allocation of resources. Then we have been talking about that what policy measures or what interventions can be used so that these externalities or this market failure can be taken care of. We have talked about property rights. We have also talked about how Pigouvian solution is there, which talks about bargaining between the parties and coming to an efficient solution of how much pollution is acceptable both to the victim and the polluter. A very important assumption in case of Coase theorem is that the transaction cost should be minimum. Whether actually it is there or not is a real question. Therefore, another way of dealing with externalities is taxing in case there is a negative externality or giving subsidy in case there is a positive externality. This concept of charging the polluter was given by Pigou. Hence, it is called as a Pigouvian tax also. In this lecture, we will be understanding the concept of Pigouvian tax, what are its advantages, and what are its various critics. We will also have a look at how do subsidies function in case there is a positive externality. As I just told you, that transaction costs are very important in real life, and thus they limit the practical private solution to externalities. As in case of Coase theorem, we see that Coase said that if there is bargaining between the victim and the polluter without actually assigning in property rights, it is very much possible that we get a market efficient solution for the level of pollution. But these transaction costs are, they are not so low as it is assumed to be. Hence, this private solution to externality is difficult to achieve. Therefore, economists prefer government to use market forces through taxes and subsidies and to align private incentives with social efficiency. That is, it is believed by a certain section that it is better that we have a government intervention where taxes are being imposed in case of negative externalities and subsidies are being given in case of positive externality, and this will take care of the social efficiency. Taxes that are enacted to correct the effects of a negative externality are called as Pigouvian taxes, I just mentioned. These are named after the English economist Pigou, who proposed them. So, why externalities and what leads to the divergence? We have already seen that any person who is consuming a good with a negative externality, he will like to equate his marginal benefit with his private marginal cost. Okay, so anybody who is producing, a producer will see that what is my benefit and what is my private cost. However, society is experiencing some kind of a marginal damage because of that externality. Let us say pollution. That is a marginal damage is being caused to the environment. Therefore, in the production process, it should not be only the private marginal cost. The private marginal cost basically means the cost which is being incurred on the production process. So, it should not be only the private marginal cost, but it should also be the cost of that externality, the marginal damage which is there to the society. Therefore, instead of having private marginal cost, it is more important that we look into the social marginal cost. And of course, the social marginal cost will be higher than the private marginal cost because the private marginal cost did not take into consideration the marginal damage. So, when the social marginal costs are ignored, then what we experience is the overproduction. We have already seen that if I am taking this graph, if this is your private marginal cost and there is some damage because of which the social marginal cost is high, private person will produce Q, whereas in society it is expected that production should be of Q1. So this extra is just being produced because we did not take care of this marginal damage. So as we see that your externalities leads to negative externalities, particularly they lead to overproduction of the good than what is actually required by the society. And this divergence of marginal social cost and marginal social benefit is tried to be reduced by using a Pigou tax. So what is Pigou tax? As I just mentioned, Pigou tax is named after British economist Arthur Pigou. It is a tax which is meant to discourage activities that impose a cost of production onto the third parties and society as a whole. So it proposes that a tax should be imposed on those activities which are creating negative externalities to a third party or to a society as a whole. So it is a tax levied on each unit of polluter's output. It is a tax which is levied on whom? It is levied on the polluter. How much? On each unit of polluter's output. That is, whatever output he is producing, for each level of output, a tax is being imposed in an amount which is just equal to the marginal damage it inflicts at the efficient level of output. That is, according to Pigou, it should be calculated that what is the per unit marginal damage which is being caused by this polluter. Based on that, a per unit tax be imposed on the polluter. So, the tax is going to be levied on the polluter. Because the tax is going to be levied on the polluter, it will change the market price, it will change the level of output such that it takes into consideration the damage being done to the environment because of this particular activity. If administered correctly, then you can move production to the efficient level of output. Okay, so this is a graphical representation of the Pigouvian tax. What do we see here? We see various types of curves. One is your marginal benefit curve. If we are measuring in dollars the level of benefit and cost, and this is the quantity per year, the marginal benefit cost is downward. Okay. Then we have what is called as MPC, which is the marginal private cost. That is the cost which is per unit cost, the extra cost being incurred by this firm in order to produce more. When this production is taking place, this individual producer is not taking into consideration the negative externalities which its production process is generating. Let us say that this firm is producing, and because of that certain water body is getting affected. Certain emissions are there in the water bodies. But because it is not directly affecting this production process, the producer is not going to account for that damage to the water body because of the emissions of this factory. The only cost this producer is going to take into consideration is his own marginal cost, which that is why we have said it is a private cost. So what is my marginal cost of producing this product? For me, I am going to consider MPC. The point where MPC is equal to MB, that is the marginal private cost, becomes equal to marginal cost, will be the profit maximizing level of output, which is at this point E, and at E the output being produced is Q1. Okay, so what we are considering right now is a situation when the firm is producing something. In its production process, it is emitting certain chemicals into a water body, but because it is not directly affecting this firm, it is not taking that cost into consideration. The only cost it is considering, it's its own marginal private cost. And the equilibrium is achieved where its own marginal private cost becomes equal to the marginal cost. But we know that this every level of output is creating certain damage to the water body. As more and more is produced, greater damage is being done because greater level of effluents are sent in that water body. Therefore, we see another curve MD, which is the marginal demand curve. Sorry, marginal damage curve. So MD is the marginal damage curve, which is rising, showing with every extra output produced, the damage cost is increasing. Right? Now, what does Pigou suggest? According to Pigou, because this marginal damage is a negative externality, and this negative externality is being done because of this firm, this firm should be imposed a tax, a proportional tax. That level of tax should be equal to the marginal damage which this firm is producing. So, we get what is called as a marginal social cost. So, it should not only be the marginal private cost, but we have to consider the marginal social cost, which is equal to marginal private cost plus the marginal damage. So, if we add up the marginal private cost plus the marginal damage cost, we get what is called as the marginal social cost, because it is taking into consideration not only the damage to the society but also the private cost. So, what we see is that if this tax is imposed, if this tax is equal to this CD, what will happen is that we will get because now what is happening is we are trying to see that instead of this cost going to the society, this cost should be internalized by way of a per unit tax CD. So, because of this, see, what we saw was that initially you had MPC, but you estimated that this is the amount of marginal damage. So, the government imposes a per unit tax to the polluter, which pushes up the marginal private cost of the producer. So, the new cost curve becomes this marginal private cost plus CD. Okay, so this becomes your new cost, which is, I'm just writing it down for you, this MPC plus CD, let us say it becomes MPC 1. So, because now even if this firm initially did not consider this damage, through the intervention of the government imposes a per unit tax. So, that tax gets internalized by the firm in form of its own cost, which becomes your marginal private cost 1, MPC 1, which is MPC plus this CD. So, what happens now? This firm will again try to see that level of output where its profits are getting maximized. Now, for him, the new level of output will be Q star. Why? Because its MPC plus CD is coming equal to MB at the point D. That is, now he will equate MPC1 is equal to MB, which is marginal benefit, which is at this point D. What happens because of this, learners, is that now you are producing the socially desired level of output Q star. So, market inefficiency, which was producing Q1 because only the marginal private cost was taken without taking into consideration the damage being done to the society is now taken care of by imposing a per unit tax of pollution in such a way that the level of tax is equal to the level of damage being done. And then what we will eventually get is a optimum level of output not only for the producer but also for the society. So, introduction of a per unit tax, which is recommended by Pigou, is actually what it is doing is it is changing the level of output in such a way that the firm automatically takes into consideration the damage it is doing by its production process. What will the government gain? Now, when this tax is imposed, this area, this will be the Pigouvian tax revenue, because this money will be going as a tax, per unit tax, that is this CD, this level of tax multiplied by the level of output the firm is selling. This blue rectangle that we have will go as a tax revenue. So what does Pigou tax do is, it is accounting for the marginal damage caused by this firm. It is equating this marginal damage to by way of a tax, per unit tax to the firm, which increases the marginal private cost to MPC plus CD. And at MPC plus CD, which is the new marginal private cost curve, the equilibrium of the firm is obtained at Q star. So this not only becomes the optimum level of output for the firm, but it also becomes the optimum level of output for the society. Now, this tax, as we see, clearly raises the cost to the polluting firm and also resulted in reduction of output. If you see this, the cost has increased and the output has decreased naturally, because whenever there is a tax, the cost will increase. But will it achieve a reduction to Q star? Yes, definitely. Why? Because with the tax T, the polluting firm chooses quantity such that the marginal benefit is equal to MPC plus CD, we just saw. So when the tax is equal to the marginal damage evaluated at Q star, then we have just seen that the marginal benefit is equal to MPC plus marginal damage at Q star. Hence, if you see the difference, that is MB Q star minus MPC Q star will give you MD Q star, or in other words, what we have said is something like this, that with an increase in the tax, the marginal private cost, new curve, has taken into account this level of damage, and this damage has ensured that the level of output becomes profit maximizing for the producer as well. Now, what is the benefit? We have said that the output reduced from Q to Q star. Okay. Has it actually given any benefit to the society? Yes, it will. See, what has happened is that this was our marginal damage, this was the private marginal cost, this is the social marginal cost. When this tax is introduced, we saw that your position moved from P1 to a new position P2, price rise from this point P1 to P2, quantity decreased from Q through to Q. So this particular area C is basically accounting for the marginal damage. Okay, this is the marginal damage, and this clearly, this area AB is equal to C, right? This may be a loss to the consumer, but if we are accounting for the society in general, the gain is greater than the loss. We'll see this in diagrammatically. What we have seen is that the society would gain area AB, which is equal to area AC in the previous diagram. So this AB, this whole area is the gain. This AB is the gain area. Okay. And this is equal to the loss of output. This C is the loss in the output. And AB is equal to C. Of course, the individual firm is going to lose certain profit. This is going to be the loss, but still there is going to be extra gain. So if everyone in the society is equal, then the net gain will be equal to the area A. Okay. Now let us have a look at subsidies. Subsidies are just an opposite of taxes. Taxes increase the price, subsidies reduce the market price. If in case of a subsidy, it's and so happen, we are saying that instead of charging the polluter a tax which increases the price, another way is paying the polluter not to pollute. That is, we ask the polluter that you do not pollute, use a better technology, and will give you certain incentives. So let us assume that this subsidy was again equal to the marginal damage at the socially efficient level, which we saw earlier in the graph. Polluting firm would cut back production until the loss in the profit is equal to the subsidy. What are we saying? We are telling the producer that see, you are, because of your production, certain damages are taking place. Let me incentivize you that you reduce your production. We will give you certain subsidy. We will incentivize you because your cutback in production will lead to lesser pollution. Till what time the producer will cut back production? He will cut the production till the loss in the profit is equal to the subsidy, because every time I am reducing production, I am losing certain profit. So if my loss of profit is equal to the subsidy, this is the point till which I will cut back my production. If I feel that my loss in profit is more than the subsidy I am reducing, I will try to produce more. So eventually, when the loss in profit becomes equal to the subsidy, that will be the level at which the producer will be in equilibrium. Now let us see this diagram. Let us say this is the quantity of green fuel or whatever. So we are taking quantity and price here. So this is the private marginal, this is social marginal cost. What we are saying is that here we are giving subsidy. We are asking him to reduce the production. So the green fuel initially chooses, let us say the fuel, instead of green fuel, we can take it as fuel. So we are choosing initially to produce Q1, which maximizes his profit because his private marginal cost is equal to the private marginal benefit, or the supply is equal to demand. We want him to produce less, let us say. So we want to produce less, his cost curve will go down. So this will move down. So when it's moved down, what is going to happen is that you will come to this level of production, and the socially optimum level of Q2 is achieved because you helped him to reduce the level of production. So what are subsidy basically doing is, subsidies are basically allowing you to reduce the production to the level you want it to, or you want to increase the production to the level you want it to. Instead of charging a tax, increasing the market price, we are going to the producer side, asking him to either increase the production or decrease the production in such a way that the social marginal cost and social marginal benefit are taken into account, and private marginal cost and social marginal costs are also taken into account. Now let us have a look at the advantages of taxes and subsidies. What are the advantages of tax? One is the environmental benefit. Automatically, when taxes are introduced, it increases the price. Many a times, the goods which are not very environmental friendly, when they become expensive, people will demand less of it. Hence, we can take care of the environmental benefit. For example, when you charge higher taxes, let us say on plastic bags, we are trying to reduce the consumption of plastic bags because by increase in the price, people will demand less, and automatically we can take care of the environment. It also leads to economic efficiency because we will be using the resources in such a way that they get their best possible use. So we are producing the goods at the level in which the society needs to be produced. Earlier, when without a tax, we were producing at a higher level of output than what the society desired. But when the tax was introduced, the level of output reduced so such that the social marginal cost was taken into consideration, or the marginal damage was covered by way of a tax. Then, not only this, when a tax was introduced, as we saw in case of a Pigou tax, what happened was that it gave certain revenue to the government. So it acted as a source of revenue to the government. Rather, what happens with subsidies, when we'll be discussing, it will rather pay to the polluter rather than giving money to the government. What are the advantages of subsidies? They are politically more feasible rather than raising taxes or increasing regulation, because taxes, as I just told you, increases the price. Rather, they are more, we can say, a more popular measure, politically correct measure, because it reduces the prices. Then targeted subsidies could help low-income families. For example, if we are giving subsidy to use, let us say, solar panels, then generally it is seen that low-income families use more of rely more on environment. For example, using firewood. So when they use firewood, we are talking about environmental damage. So instead, if we give them subsidy to use LPG instead of firewoods, then we are not only bringing them to use a more environmental friendly product, we are also taking care of the healthcare cost which is associated with use of a firewood. So this can help the low-income families, and also it supports new and emerging technologies, because when the firms feel that if we use a better technology, it will lead us to a we'll get a better subsidy. Or for example, these days we say a government has initiated to a lot of extent. The government of India is talking about the use of solar panels. They're talking about hydrogen fuel. They're talking about electric vehicles. They're all supporting innovations. They're also supporting many companies which were not using them earlier are trying to use it, because they can see the subsidy which they get if they use such green fuel. So that is the advantage of subsidy. Now, let us understand what are the problems associated with subsidy. Because subsidies are introduced, it is a way of reduction in the production cost. Many firms will like to enter, and so that the total pollution increases, and they know that more pollution will mean more subsidies. So eventually, it will lead to a greater pollution. Then you need to raise taxes to pay subsidies. Where will the government get money to pay subsidies? Because subsidy is an expenditure of the government. So in order to pay for those subsidies, either the government is going to raise the taxes, or the government is going to increase its own expenditure, which is again a fiscal deficit, macroeconomic problem. Also, many times subsidies are often politically motivated, and then they get very difficult to remove when no longer needed. We see that if, for example, government tries to remove the any kind of a subsidy, there's a lot of, because they're populist measures. So when the government tries to remove these subsidies, they become very difficult, because then it is taken in a negative sense. So it is very difficult to remove a subsidy, and it's easier, rather from a behavioral point of view, a reduction in taxes is taken as a welcome step rather than a reduction in subsidies. Also, the polluter is receiving money from the government rather than paying. It is the polluter who is getting the benefit rather than he should be paying the government, because he is damaging the environment, but the government is paying him for not damaging the environment. So it is the polluter who is getting the money from the government. Then also, it is seen that the benefits often occur to the higher income household, as they are more likely to invest in new equipment. Let us talk about solar panels. Let us talk about electrical vehicle these days, because they are so expensive. New technology is generally expensive. So it is generally the higher income households which will take the benefit of these subsidies rather than the low-income households. Similarly, the big corporations are going to take the benefits of new technology, because they can afford new technologies and get subsidies, rather than the small scale and micro enterprises who are going to benefit from these subsidies. So it further creates a problem of income and welfare distribution. Now, let us have a look at the problem with the tax, imposing a Pigou tax. One, it is very difficult to measure. We have seen there that the tax CD in the diagram where we saw should be such that it should be equal to the marginal damage. But theoretically, it appears to be very easy. But in terms of public finance policy making, it becomes very difficult to measure the right amount of tax which should be imposed, so that it is just equal to the marginal damage which is being caused due to that particular economic activity. Also, Pigouvian taxes tend to be regressive in nature. Regressive means that they are creating a burden on all sections of the society equally. So, because it is an indirect tax, a tax on the output increases the market price. So, people who have a lesser income or people in the low income households also have to pay a higher market price. So, compared to a higher income household, this extra increase in price is more burdensome to the lower income group. So, the loss, they will definitely reduce the consumption of that good, or it creates a greater distress amongst the lower income households. So, these taxes are generally considered a regressive tax because it increases the market price, and extra burden lies more on is more felt more by the lower income households. Then we say well-defined property rights are a better way to deal, because without any government intervention, we were getting, if you remember in the Pigouvian theorem, we were getting to the market efficient price because within the polluter and the victim, they were deciding that how much should be the level of effluent production. Political will is another problem, because charging a tax, increasing a tax, as we all see whenever the budget is introduced, any increase in tax is opposed. So, no politically, with a political bend of a mind, government would actually like to impose a new tax in name of pollution. Also, it gives incentives to find illegal methods, because you know that this is going to be levied on the level of output I am producing. So, if they do not disclose the if they disclose the lesser amount of output, they have to pay a lesser price. Hence, people are rather incentivized to disclose lower level of output than what they are actually producing. So, let us just give a quick revision of what we have done in Pigou taxes and subsidies. We have talked about what is a Pigou tax. We have said it is basically a tax imposed on the economic activities which generate negative externalities and which are borne by the parties not related to it. Hence, it is not considered in the marginal private cost. The main objective is to remove market inefficiencies such that the marginal private cost is increased by the amount generated by the negative externality. That is, if you remember the diagram, the MPC plus CD, that CD was just equal to the marginal damage caused at that level of output. And then, however, charging a tax is not always a desired public policy choice. We also talked about subsidies, which is a converse of taxes, and we've seen the problems created by both and the advantages of both tax and subsidies. So, that's all in this lecture. I hope you enjoyed it. Thank you very much.